Hello traders, how are you doing? Today is Sunday, January 15, 2017. Today is the second update this weekend. I commented the latest update that I was going to comment on scaling in some trades. Yesterday's update was about scaling out. This is important because these kind of techniques, both scale in, scale out, will be it will be one of the most used tools for me during this year due to Donald Trump's uncertainty factor. So there won't be any much more straightforward trades with clearer signals and trends. That is over already. If you are interested in knowing what I have to say about scaling out, when a trade turns out to be profitable and then reducing the risk, and go to latest update. This is the one that will have some few words about scaling in some trades. Well, following the same logic that the trading world is not as easy and money management is not as easy as some people try to sell the idea to others. Overall, people that are so-called trading gurus that are much more busy delivering webinars, delivering courses and training people and selling DVDs, etc., instead of trading. The money management is way more complex. It is very popular to say that it's almost a sacrilege, a sin, to scale in a negative trade. But again, that is relative. That it's relative to your overall understanding of what you're doing. During this year, it won't happen only once, but several times I can bet that we're going to start scaling in gradually the trade that maybe we're trying to position ourselves beforehand the move happens. Why scaling in? Depending on the concept, if you are planning, for example, to risk 2% of your account in one direction, let's put an example, bullish direction, on euro dollar. Not necessarily it means that you need to open the whole 2% risk at one single time in one single trade. Overall, under uncertainty circumstances like the ones we have now, it is a wise option to start putting your toes in the water gradually. So, how bad could a scale-in be? If, for example, I decide to risk an overall in a lot of trades, 2% in a bullish euro-dollar trade, for example. And let's say that I decide to open at a London opening a partial risk. Instead of the original 2%, 0.5%. At, let's say, London opening on Monday. I wait some hours to see if it moves in my favor or not. But with the safety that I am risking 0.5 instead of 2%. Let's say that after 24 hours the market really didn't move too much against or in my favor, like all Mondays are usually consolidation days. But while I do some intraday analysis, I still hold a bullish bias. And let's say that on Tuesday I open a trade risking another 0.5% of my account. That means opening a 0.5% on the original 2% maximum risk on that trade. Meaning the trade that I open on Monday and that I will open on Tuesday will sum 1% of my account. You tell me, is it that bad that maybe that second trade risking 0.5% of my account to be opened while my initial trade maybe is 50 pips in a loss, 25? What's the difference? My risk is the same. Actually, I'm not even running the maximum risk of my overall bullish position on euro-dollar. What's the difference? The second lot will be smaller in size. Well, in this case, the second one is going to be bigger in size. Sorry, I am mixing some data here in my papers. The first one, since let's say I used a 50 pip stop loss on Monday. And the second one, let's say it's a 35 because my stop loss is the same. Then my lot could be bigger. If for some reason I decide to continue as default using my overall stop loss of 0.5%, then my stop loss will be below the Monday trade. And so on. Imagine that I do that on Thursday and Friday, risking 0.5% every trade. Imagine that none of the trades are stopped out in a loss. And maybe next week, all 4 trades are going to be in profit, and I will start scaling out as I just explained in the previous update. Or how about even using this, that it's like a sacrilege again? Parabolic trading, leverage, parabolic positioning, parabolic averaging, whatever you want to call it. That the lower it goes, the bigger the lot is. When we start understanding that money management is not a fixed thing, that it depends on our comprehension and our interest, because it's not the same that maybe if you're interested in holding a long-term bullish trade in euro-dollar because you're following, let's say, some fundamentals, maybe you would even use a 200, 300 pip stop loss, and you could be opening trades gradually during 1 or 2 months while the average position is in negative. And that doesn't mean you're doing things improperly. The only way that you lose money in the markets is because you don't know what you're doing. Of course, it's very tough to know what you're doing. This update's an invitation for you all to consider and to question what are called like hard rules in trading. It doesn't matter the hard rules. It doesn't even matter what I am telling you now. The important thing is what works for you. If it doesn't work for you, scaling in because maybe you get very nervous and then you sabotage yourself, then don't do it. That doesn't mean it doesn't work for somebody else. Scaling in in a creative way, like these ones that I am just explaining, because it can get really, really complicated. That is why it is said that 50% of the profits in the trading world is money management, and it is true. Because it's another part. It's not enough to have an edge in trading. You need to learn an edge in money management, what it works for you. When I started my trading career in 11 years ago, I was very, of course, I started being a non-profitable trader. I lost a lot of money at the beginning. But important thing is that at the beginning, I was very comfortable keeping trades open during the weekend, for example. That's not the case anymore. So if I applied the same approach I had 10 years ago now, the most likely thing is that I will fail. Not because I am wrong, it's because it doesn't fit me anymore. That's what it's all about. Trading is just about that, finding what it works for you. In trading, it's like the utopia of free thought, because there are no hard rules. Who's going to question your profits? Even if people don't like it, if you're constantly profitable, would you care about what others have to say about your trading approach? Will you be really worried about what others could think of you scaling in or scaling out, scaling in negative trades or not, if you constantly profit the markets? Of course not. You wouldn't care. On the other hand, you wouldn't spend time explaining and saying and fighting back the detractors. No, because you will understand that everybody will be talking, and your conception of trading will be equal to your talents, intelligence, flexibility, creativity overall. So yeah, it's valid that for some people it's a complete sacrilege to scale in negative trades, while others constantly make money thanks to scaling in negative trades. It depends if it works for you or not. So in the Dukascopy webinars that I will be delivering as always from Monday to Friday from 7 a.m. GMT time to 8 a.m. GMT time. And since my approach has changed already to more intraday because of the reasons I explained before in other updates, you will be seeing that I will start scaling in and scaling out regardless if it is a negative trade or not. Warning: if you scale in just because you are betting that the trade will get in your favor and at some price you will take out all the lots at break even, that's another thing. That's not a precise and correct approach. When you are scaling in, scaling out, open a single trade, or not following a logic of gambling, the most likely thing is that you will end up losing money as in a casino. That means 99% of the times. But that's another story. That is not trading. So let's keep an open mind during the webinars. What I approach to you is my way to trade, my style, my personality. If it doesn't fit for you, don't even bother to fight, to say I am wrong, or if you agree that I am right, because that is not true. It works for me, it's true for me, it's profitable for me, and that's the only thing I care. You should only care about that also, if it works for you. What of the old information that you receive from me or other sources is useful for you? Can you constantly grasp a profit of the markets following something? Then it's good. No matter if somebody doesn't agree with you, if you can constantly make money out of the markets following scaling in, scaling out, leverage, not leveraging, etc., that's the way to go. I would like to thank everybody for listening to this update. Remember that I expect the same time, same place, delivering Dukascopy webinars. This is Alberto Alvarado. Have a wonderful Sunday. Trade safe, be safe, and bye-bye.